GDP fell by 0.9% in Q2, marking 2 straight quarters of negative growth. In Q1, we all know GDP fell 1.6%. Here's the real GDP chart. Current dollar GDP increased 7.8% at an annual rate, or $465 billion in Q2 to a level of $24.85 trillion. Home construction down 14%, ostensibly because of the interest rates increasing. Inventories, which helped boost GDP in 2021, dragged down growth in Q2, so supply chains easing, taking away 2 percentage points. Chamath, what's your take? Do these year-over-year comparisons work? We were talking in the chat a little bit about the spike in 2021 versus the dip in 2020. What's your take on this?
I mean, I think you just summarized it. People are really fixated on these numbers without understanding basic statistics. So just taking a step back, if you go to the Bureau of Economic Analysis, which is an official website of the government of the United States that posts GDP, the title makes it pretty self-obvious what we're dealing with here, which it says, Nick, you can put it up there. Real GDP, the percent change from the preceding quarter. So things can still go up positively, but still be negative if it doesn't go up by the same or more than the quarter before it. The thing that we really have going on is that over the last 8 quarters, we've had all kinds of very turbulent data that's made the trend line unpredictable. And the most obvious way to see this is actually in one specific subsector, which we'll get to in a second, which is around US e-commerce adoption. You see this one huge spike coming out of nowhere. And then eventually everything has settled back to trend. The same way, I think what we're waiting to figure out is how many quarters does it take for us to get back to on-trend growth in the economy? We had a massive shortfall in Q2 of 2020. We had a massive surplus in Q3 of 2020. We've had a country that's been getting back to finding equilibrium over the last 5 quarters. So we don't really know what the steady state growth should be. This is why I specifically had such an issue with the tone the White House took, which was trying to explain away that this isn't a recession by trying to create doubt in the definition. Instead, I think it would have been much better off just repeating what I just said and explaining basic statistics and actually showing that the country is headed in the right direction, largely speaking, from a really crazy one-time externality that nobody could have predicted. That it's going to take some number of quarters. And so really what you should look at, and Jason, you've pointed to this, is employment and wages, and try to be a little bit more circumspect in overreacting to any one quarter of data. By the way, the Fed exactly just said the same thing yesterday when they raised 75 basis points. They said, we are not going to give guidance anymore because things are too turbulent. We're going to remain vigilant on inflation, but mostly we're going to be very near-term data dependent. So I would boil all of this in saying, let's not overreact to a quarter's print here or there, and specifically the label. I think the White House made a mistake in trying to basically think, we all didn't understand what a technical recession was. I think instead we should just focus on what we have to do to get back to solid state equilibrium.
Yeah, and just to put a pin in the definitions, we all know the common definition, 2 successive quarters of negative GDP. However, people have said it's a temporary economic decline during which trade and industry activity are reduced. So there's a sort of debate and splitting hairs going on, Sacks, which was kind of stupid.
The big news this morning is that we no longer know what a recession is. This is such a vast and complicated question. You might as well be asking, what is the meaning of life? Now, I remember in the days of Republican presidents, we had a very simple definition of recession, which was 2 quarters of negative GDP growth. But now that we have a Democrat in the White House, we just can't know these things. Why even ask such difficult questions, right? I mean, that's basically the media coverage today, and it's absurd. I mean, and you saw for the last week, the administration and its spokespeople have been trying to muddy the waters on the definition of a recession. And it was laughable as they were doing it. But now you see the media coverage today and you realize like they've bought into this nonsense and they're carrying so much water for the administration. Look, the headline should be the Biden recession has begun. That's it.
If you had 3 minutes and 45 seconds for your Biden over under with Sacks, you took the under, you won.
We're in a recession. He's the president. And if we had a Republican in the White House, it would be Republican president recession has begun.
Yes.
So the media here is carrying so much water to try to avoid the obvious headline. I just explained it. Instead of reporting the obvious headline, they're now saying that we're approaching recession or we might be in recession. Or we have all these difficult technical issues. Listen, we're in a recession. It started. It might be a shallow recession. We don't know yet.
Yeah.
It's a recession in which the unemployment rate as of today is low, although the labor participation rate's also low. So listen, we're at the beginning of a recession. It might turn out we might have a bounce in Q3. This might be more of a double dip. I suspect that's what it'll be. But we know the cause of this. The cause of this recession is inflation. If you look at the economy's growth in nominal terms, it grew at 7 point something percent, but because inflation was at 9%, you have to subtract them in real terms, the economy is shrinking. And who is to blame for inflation? Well, Jay Powell at the Fed, because he reacted way too slowly, but also the Biden administration for all the spending they did.
How much sooner do you think they could have reacted? 2 quarters? Maybe?
No, like 9 months earlier.
So 3 quarters.
We got that first surprise inflation print last summer. It was May, I believe, that 5.1%.
We started to talk about 10-year break-evens tips in May of last year.
Yeah. So they could have gone quarter or two.
No, the 9 months. And they continued. Not only did they not raise rates or signal any desire to raise rates for 6 months, they continued quantitative easing for 9 months, which just makes no sense. But they should have taken their foot off the accelerator right away.
Not 9 months. They only stopped in June of this past year. So we've only been quantitatively tightening for 2 months.
I thought they stopped the bond buying program in March.
Maybe that's right. Yeah.
Yeah. But they stopped quantitative easing in March. But you're right. That tightening is just something they're getting started with. But the point is they should have stopped easing, right? Like, why would you need to keep intervening in the markets to buy more and to basically push out more money?
Is the reason for this that Powell and Yellen just haven't lived through highly inflationary times? I just read
they're older than I am.
I'm just saying they haven't been in office and doing Fed policy. Like I just read Volcker's book. If you haven't read it, it's pretty great, his biography. I mean, what he had to do in 81, 82 was super severe. But we just haven't lived through this in our life. So I guess people are just not used to having to tap the brakes in our lifetime.
Look, what happened is that the administration reacted in a political way to the inflation print. They invented this word. Well, the word transitory existed, but they applied it. You heard this word used relentlessly for about 6 months. So the administration went into denial mode.
Yeah.
And then by the end of the year, it became clear that it was persistent. And I think the issue with Powell is that he is basically responding to headline risk, right? So he didn't respond to, the inflation problem last summer. He waits until the headlines tell him he has to react. And so now the thing that he's worried about is recession. Obviously, he knew.
No, he's worried about inflation mostly, right? He's
worried about inflation, but if you look at yesterday's right, but if you look at his comments yesterday, it was more dovish comments. They did a 75-point rate hike, but the comments were more dovish, and I think it's because he knows that today we have this second consecutive quarter of negative GDP growth. So now he's trying to balance recession risk against inflation risk. But the point is that the Fed's been very slow to react, and the administration basically just tries to relabel and rebrand problems instead of confronting them head on.
Hey, Chamath, when we look at this chart you pulled up before, and we see this massive spike, Q3, Q4, Q1, Q2, a little bit in Q3, and then Q4. I mean, this massive 1, 2, 3, 4, 5, 6 just extraordinary quarters, or 5 out of 6 in terms of GDP. That's all stimulus in your mind, right? This is the money drop.
No, that was lockdowns in Q2 2020, Jason. They locked the economy down.
Yeah, but so people were spending online, and we'll get to the Chamath story about Spotify, but
it's not all of it. But the point is,
it's some combination of lockdown and
excess money, right? Excess money because of loose financial conditions distort what true supply and demand should be.
Got it.
Right? And excess money can come from the government. But in this case, excess government money went from the government into the hands of individuals who then participated in the public markets, and they distorted what it all looked like. And so there was a lot of purchasing activity that was propped up by what seemed like an endless supply of free money.
Right. So when we look at yeah, good.
And so now that money is getting taken out, we don't yet know what the real equilibrium economic growth rate should be, because you have to remember, We have not seen an era without federally introduced spending, without federally introduced forms of quantitative easing since the great financial crisis. So we have been propping up our economy for 14 years straight now. So we have distorted the prices of bonds and fixed income. We've distorted the prices of equities. We've created an asset bubble in crypto out of nowhere. And now we have to do the hard work of figuring out what the real supply demand is in the economy. And we don't know. If it took
6 quarters here, there's 6 quarters of just massive GDP spike there from the preceding quarters, and we have 2 down quarters. Is it going to take 6 quarters to wash this out, or longer, I guess?
No, longer, because what David said is now making the problem even worse. So because Powell was catering to whatever pressure he's been getting, and he must be getting some severe pressure from the White House, those were really dovish comments. But what is the problem when he is dovish? Well, the practical reality is a couple of things. Number one is typically the yields of long dated bonds go down. Okay. That essentially tells everybody else to reprice assets. What does that practically do? It makes the cost of borrowing roughly cheaper. Okay. It makes the price of equities, particularly ones that are far out on the risk spectrum. So specifically, let's focus on NASDAQ and crypto, right? Tech stocks, biotech stocks, and crypto stocks go up much more aggressively. So what has Powell effectively done? He has synthetically created a form of easing again, right? Like his job at the Federal Reserve, if you think about the money supply as a pipe, it's to shrink the pipe to close off demand to get things in equilibrium. So even though he's doing this, by the language that he's doing, he's effectively allowing market participants to basically guess that the worst is over and now we're going to start to expand the pipe again. And so they go to the end state. So what he effectively did in one speech is basically put a pin at the end of this year and is telling the markets, I'm mostly going to be done. And if anything, I'm probably going to be cutting in the back half of 23. Go on your merry way.
And there is no CP.
So the problem with that, Jason, is it's now pushing the problem out another 8 quarters. Like, we need to stop this nonsense. He needs to be definitive, and he needs to fundamentally break the back of inflation so that you find out what the true demand is in the economy.
Yeah. And he did 0.75 yesterday. The markets rallied on his sort of the assumption that he would do a couple of more of these rate hikes and then he'd be done at the second half of the year. And then, hey, maybe we can get back to growth or some normalcy related to all of this. And by the way, there was an interesting story the Sacks would be interested in. Did you read Paul Volcker's biography yet, Sacks?
No, I've not read it. I'm familiar with his record, but yeah.
Like at one point, Baker and took Reagan and Volcker into a room off of the White House so it wasn't recorded and just said, Volcker, the president does not want you to raise rates going into the 84 election, full stop. And Volcker's like, well, I wasn't planning on raising them. So there's a lot of politics in this, even though people claim
they'd already done enough. I mean, Volcker raised rates all the way up to like 20%. He broke the back of inflation. It created a very severe recession in, I think, 1981, 82. But by 1983, the economy was rocketing back with lower interest rates, and they basically have solved the inflation problem. Hopefully, we're not in that situation where Powell has to jack up rates so much to break the back of inflation, because it means that we'd be in an even more serious recession. Right. So I hope we're not in a Volcker type situation.
But just think about that spread, Sacks. 20% versus like 3 or 4% we're trying to get to.
We've never in the history of America ever had CPI print above 4.5% or 5% without inflation being brought down by having Fed funds not also be greater than 4.5% or 5%. So at some point, inflation will turn over and we'll print 6 and 7%, but that's still not below 4.5% or 5%. And right now, our target Fed funds rate is between 2.25 and 2.5%. So we could still be only 50% of the way there if inflation remains at 4 to 5%. And this is what I think market participants don't want to hear. They don't want to hear that there has to be a meaningful form of tightening. And politicians don't want to hear that. The White House for sure doesn't want to hear it. The problem is that if Powell caters to too much of that feedback, he's not going to do what he's supposed to do and why he's put in that job.
His job is to get it to 2% and keep price stability and full employment.
I do think there is a balance here. I mean, the reality is we do not want Powell tightening more than he should or more than is necessary to solve inflation because it will cause a serious recession. So I think we're caught between two pretty bad options here. And it's because I think that what happened last year contributed to this. I mean, look, if you go back to that chart that you just showed, what happened in Q2 of 2020, we had a very healthy economy going into 2020 and 2019, right? And then in Q2 of 2020, we had COVID, but we made the situation even worse with lockdowns. And we basically shut down the whole economy, brought it back, at least in most states, in Q3. And then the Fed started printing and Congress started printing $10 trillion. Well, still, by last year, the economy was back. We had something like 5.7% annualized growth. This year, it's negative. Why is that? I mean, this may be the lingering effect of all that stimulus, but I think that it is. But I do think that the administration made it worse by sending checks into an overheated economy. They also created energy scarcity, and they just kept, spending more money.
I'm not saying the White House isn't without fault, David, but I do think that if all of these geniuses could have actually just taken a simple econ and stats 101 class and explained how year over year measurements work to the American people, I think they're smart enough to understand it. We didn't have to go down this convoluted route. We could have just explained, we put a lot of excess money in the economy. We don't yet know what the full effect of that is. We need to let that wash through. In the meantime, you're going to see some crazy numbers from time to time, and we just have to be patient.
And the other crazy things you're going to have, looking at second and third order effects, is all these downstream effects. People are making business decisions going into these economies. Shopify just laid off 10% of its workforce, about 1,000 people on Tuesday. Their stock is down 10% past 5 days, overall 70% year to date. And if you look at this chart, and Toby took blame for this, he basically said, listen, we thought that this was going to be a fast forward into the future, that people would adopt e-commerce in a major way and that would stick. Here's U.S. e-commerce adoption growth rate, massive spike when people were forced to buy all their goods online. And now it is regressing to the mean.
I mean, mean reversion is a bitch. If you look at Shopify stock, if you look at Peloton stock, if you look at Affirm stock, if you look at ARC, a lot of these things were trending in a great direction. They had this short-term crazy behavior in the middle of all of this free money, and now they've mean reverted. And, we're in the midst of finding out what the real price is. I got to give Toby a huge, round of applause, because he is such a great CEO. And I'll tell you why. Last year, in the middle of all of this wokeism, he wrote this incredible memo, which was, we're not a family, we're a team, which I thought was exceptionally well written and really got the point across. This time around, he just owned it. He's like, I made a huge bet that all of this behavior change was going to be discontinuous and permanent. And it turned out I was wrong. I'm sorry for that. And here's how we're going to have to course correct. In both cases, he kind of just put it all out there and he owned it. And I think that that's all you can do when you make a bet and it's wrong.
And here's what he said. It's now clear that bet didn't pay off. Ultimately, placing this bet was my call to make, and I got this wrong. Now we have to adjust. As a consequence, we have to say goodbye to some of you today, and I'm deeply sorry for that.
I mean, everybody made that mistake, right? So, it's just, you're right, Chamath, just own it. Everyone was thinking the same thing. We all were talking about how COVID was this acceleration of this virus, and it was going to accelerate all these trends. And the acceleration.
The rude awakening is going to be for all these people who made all these bets, assuming that it's permanent. And specifically, I mean, especially around real estate and work from home and all of the stuff, benefits, and it's all going to change now. And the reason I say that is the combination of reversion to the mean will impact a company's bottom line. And those boards of directors and CEOs will say, okay, we're just going to have to reset expectations. And that's going to touch the employees. I don't know if you saw this leaked transcript, but Zuck was asked a question from this employee in Chicago. That was unbelievable.
He was asking about his emotional support days or something.
I think in the middle of Zuck having a really serious heart to heart with the company about how we're going to have to buckle down and, get this company back on the right track.
Performance. Yeah.
One dude, Schmengi from the back raises his hand and goes, "What about the COVID extra vacation days? Will those get canceled?"
Zuckerberg he literally, his head almost exploded. He's like, did you not just listen to what I said? I just said, if people are not performing at a high level, maybe they shouldn't be here. And you're asking me about more days off?
Just fire that person. Just say, obviously, you don't get it. You didn't listen to anything I said. You're not right for this team at this time. Goodbye.
He said a version of that. He's like, there's a lot of people here that may not be the right